Welcome to the Deep Dive. Today we're really getting into a specific set of sources. It's a newsletter focusing right on the Indian stock market around the week of June 8th, 2025.
That's right.
And our mission really is to take all this data, the observations, projections, everything this newsletter offers, and pull out the key insights for you.
Exactly. It's like getting a snapshot, a very specific window into the market at that exact moment. We've got the ingredients, right?
Mm-hmm.
Recent market parameters, calculations for expected returns, some notes on historical trends, and even specific investment ideas and sector data.
Okay, so the goal then is to figure out what picture does all this paint, the state of the Indian equity market, early June 2025. What's it telling us about valuation, momentum, sentiment, maybe even strategies?
Precisely.
All right, let's jump in. Let's unpack those core market parameters first. For the week of June 8th, maybe compare them to the week before.
Okay, sounds good. So the source calls them Rvcc parameters. And looking at the week ending June 8th compared to June 1st, a few metrics did shift a bit.
Like the PE ratio.
Yes, the PE ratio, the classic price to earnings, how expensive the market seems, it nudged up slightly from 22.3 to 22.5.
Okay, so just a small tick up.
Yeah.
Investors willing to pay fractionally more for each rupee of earnings. A touch more expensive, basically.
Exactly. And similarly, the PB ratio, price to book, which compares market price to the company's net asset value.
Another valuation angle.
Right, that also went up from 2.6 to 3.7, so another small rise there on the valuation front.
And what about the market cap to GDP percentage? That's the one people sometimes call the Buffett indicator, isn't it?
That's the one. It also increased. According to this source, it went from 122.4% up to 123.51%.
So the overall market value compared to the size of the economy, that expanded a bit too that week.
Yep, based on this data.
Interesting. Okay, what about momentum? I see an RSI figure mentioned.
Yes, the RSI, Relative Strength Index. It's a momentum indicator, helps gauge if things are looking overbought or oversold based on recent price action.
And that changed quite a bit.
It really did. It jumped pretty significantly from around, the source says 55.25/54.45, let's call it mid-50s, up to 65.
Wow. Okay, so that suggests much stronger upward price momentum kicking in during that week.
Definitely points that way.
And FIIs, foreign institutional investors, their positioning seems to have shifted quite dramatically too.
Yeah, that's another big swing. Their net open interest change went from being negative, minus 3,793, to positive 1,010.
So flipping from a net negative position to a net positive one, what might that imply? A change in their short-term view, maybe?
Could be. It certainly suggests a shift in their positioning or perhaps their sentiment towards the market in that period.
And the Nifty Y index itself, that was climbing too.
It went from 24,750.70 on June 1st to 25,003.9 out on June 8th. Crossed that 25,000 mark.
And didn't that move also take it above some kind of technical level?
Good point. Yes, the source highlights the Nifty 13-day exponential moving average, the 13 EMA. On June 1st, Nifty was just barely above it.
Okay.
But by June 8th, it had moved more decisively above it. $25.3 versus a 13 EMA, around 24,750.
And trading above a key moving average like that, that's often seen as a positive sign, technically speaking.
Often, yes. Analysts tend to watch those levels.
Right. And the last parameter here, the India VIX, the volatility index.
The VIX. That actually decreased, went from 16.08 down to 14.63.
Okay, so lower VIX. That means the market was expecting less choppiness, less volatility in the near future.
That's the general interpretation, yes.
Yeah.
A decrease often suggests reduced anxiety or expectation of big price swings.
Okay, so let's try and piece that snapshot together for that week. We've got valuations creeping up slightly, but momentum really picking up. FIIs turning positive, the index gaining ground and clearing a technical level, and volatility expectations calming down.
Yeah, it definitely paints a picture of, positive short-term dynamics going into that specific week in early June.
Right. But the source doesn't just stop there, does it? It looks further out, using a model based on that Buffett indicator to estimate future returns.
It does exactly that. It offers a specific calculation for expected annual returns for the Indian stock market.
And what's the headline number they come up with?
Well, according to their original Buffett indicator model, the source projects an expected annual return of 6.3% per year for the coming years.
6.3%. That's quite precise. How do they arrive at that? What are the components?
They break it down into three main parts. First, there's the contribution from economic growth in local currency terms. They peg that at 6.86%.
Okay, growth-driving returns. Makes sense.
Second, they add the dividend yield, which comes in at 1.53%.
Right.
But then there's a negative factor. They call it valuation reverse to the mean, and that subtracts 2.1%.
Ah, okay. So the idea is growth and dividends push returns up, but because valuations might be a bit stretched, the model assumes they'll eventually come back closer to the long-term average, and that acts as a drag on the total expected return.
Yeah.
Pulls it down to that 6.3% figure.
That seems to be the logic, yeah. It suggests that current valuation levels might temper future gains somewhat, even with decent economic growth and dividends.
Does it mention any other models?
It briefly mentions a modified model, but interestingly, it says the components and the final expected return are basically the same. Still comes out to 6.3% a year.
So whichever way they slice it, using this approach, they land on a pretty moderate 6.3% annual return expectation. That's definitely something to keep in mind, balancing it against that short-term positive momentum we just saw.
Absolutely. It provides a longer-term perspective based on valuation. Now, shall we shift gears a bit? Look at the more specific notes and investment ideas in the source.
Yeah, let's do that. I did notice something a bit odd in the structure there's heading, U.S. market valuation. But the bullet points under it seem to be all about India.
Yes, that looks like just a minor formatting quirk in the source document. The content itself, the points listed there, are definitely focused on the Indian market and investment strategies.
Okay, good. So what does it say there?
Well, it starts by noting positive sentiments are prevailing. And based on that, it makes a pretty direct suggestion. Start with new SIPs and STPs.
Right, systematic investment plans and systematic transfer plans. So basically keep drip-feeding money into the market regularly.
Exactly. The implication is that the current environment, this zone as they call it, is suitable for accumulation over time. It even says time to accumulate.
So despite the valuation levels we discussed, the positive sentiment makes it a time to be investing consistently.
That seems to be the message. It also suggests considering investing in business cycle funds with 2-3 years view.
Okay, so a strategy looking at the broader economic cycle, thinking medium term, maybe 2 to 3 years out, trying to align with where the economy might be heading.
Yeah, that's the idea behind business cycle funds. Aligning your investments with anticipated economic trends or phases.
Does it get more specific about where to invest? Fund types or sectors?
It does. It mentions the current fund focus on large cap funds and hybrid funds.
Large caps and hybrids.
Okay.
And specific sectors.
Yes, the sectors highlighted are banking, finance, and defense.
Interesting. Banking, finance, and defense. So putting it together, the source sees positive sentiment, advises regular investing and accumulating, possibly using business cycle funds, and points towards large caps, hybrids, and those specific sectors.
That's the gist of the investment notes, yes. It seems to link that feeling of positive sentiment and the recent trend directly to these actionable ideas.
Now, the source also touches on historical trends, right? Gives some context on how the market's been moving.
It does. It provides a quick summary, highlighting that the trend hasn't been smooth sailing. It mentions negative periods starting Jan 2022, then shifts to positive, back to negative or neutral. Basically, it shows quite a bit of volatility over the last few years.
So definitely not just a straight line up.
Far from it. But focusing on the more recent stuff, relevant to our June 2025 snapshot, it notes a negative trend signal from December 20th, 2024. And it mentions that a trend reversal wasn't seen, well, until a specific date.
Yeah, which date was that?
It clearly states, trend reversal on 21st March 2025. So March 21st is marked as a key turning point back towards a positive trend, according to the source's method.
Okay, March 21st. But wasn't there another note, something about a brief dip after that?
Yes, good catch. It does mention that Nifty closed negative on April 4th, 2025, calling it a short-term bearish trend for that specific day, even though the previous week had closed positive.
Right, so a little blip in early April. Yeah. But what was the prevailing trend leading up to our early June timeframe?
The latest general trend observation provided is trend turned positive again after 18th April 2025.
Ah, okay. So from mid-April onwards, the trend was considered positive again, leading into the June data we're looking at.
That's the timeline suggested. And reinforcing that, back in the Rvcc parameter section, it also concludes that the Nifty Small Cap 100 and Nifty Mid Cap 150 indices remained positive.
Which fits with that broader positive trend kicking in from mid-April.
Exactly.
Okay, now let's add another layer. The source provides a table with sector-specific performance for that week ending June 8th. How did different market segments actually do right then?
Right, the table gives us that granular view. And interestingly, for that specific day or week ending June 8th, most of the broad indices, MFTY 100, 200, 500, the mid and small cap indices, they were actually showing negative percentage changes.
Oh, so even though the overall trend since mid-April was noted as positive, that particular week saw a bit of a pullback.
Seems so. The declines weren't huge, mostly ranging from about minus 0.65% to minus 1.67% for the mid-cap 50 index, but yeah, mostly red for that period.
Any outliers?
The Nifty Microcap 250 index had a much smaller negative change, just minus 0.08%, so it held up relatively better in that specific time frame.
But maybe the most striking thing in that table is looking at the valuation metrics across the different sizes, large cap versus mid and small cap.
Yeah.
We saw the overall market PE and PB earlier. How do they compare segment-wise?
Yeah, this is really where you see a stark difference. So the large cap indices like the Nifty 100 had a PE around 22.41 and a PB around 3.74,
Sure.
pretty much in line with the overall market numbers we discussed.
Oh.
But then you look at mid caps. The Nifty Mid Cap 50, for instance, its PE was way up at 39.81.
Wow, almost 40.
Yeah, and its PB was 5.67. And small caps weren't far behind. The small cap 100 had a PE of 32.63 and a PB of 4.49.
So mid-small cap stocks as a group were trading at substantially higher valuation multiples, PE and PB, compared to large caps at that point in time. Considerably more expensive, relatively speaking.
Absolutely. That's a very clear takeaway from this data. The valuation premium for smaller companies was significant.
And dividend yield.
Generally low across the board in that table, mostly under 1.3%, confirming the earlier point about dividend contribution.
And the VIX. Still that lower number.
Yep. 14.63, shown in the table too, consistent with the parameter section, reflecting that lower expected volatility.
Okay. Let's try and bring all these different threads together now for everyone listening. We've got this snapshot from early June 2025. Valuations are somewhat elevated generally, but particularly high in mid and small caps.
Right.
Yet we saw positive short-term momentum, positive FII flows recently, and volatility expectations had eased. Then there's this projection for future returns, a moderate 6.3% per year, based on that Buffett indicator model, which explicitly factors in valuations potentially coming down. We also have the context of recent trend volatility, but with the trend noted as positive since mid-April.
Yeah.
And alongside all that, these specific investment tips accumulate, use SIPs, focus on banking, finance, defense, large caps, hybrids.
It's definitely a complex picture when you lay it all out. What's really interesting is thinking about how these pieces connect, or maybe where there's tension.
Like the valuation numbers.
Exactly. Those high PE and PB ratios, especially for mid and small caps, they seem to directly feed into that valuation reverse to the mean component in the 6.3% return calculation.
So the model is basically saying, because valuations are high, future returns might be lower than growth alone would suggest.
That's the implication, but then you contrast that with the investment notes, positive sentiments, time to accumulate. How do you square that advice with the high valuations and the moderate long-term return forecast?
That's the key question, isn't it? Is the source saying, jump in now because sentiment and recent trends are good despite the valuations? Or is it maybe that the specific recommendations focusing on banking, finance, defense, or large caps hybrids are seen as the way to navigate this kind of market? Maybe those areas are considered better value or have better prospects.
The source doesn't explicitly spell out that reconciliation. It presents the valuation data and the moderate return forecast, and then separately presents the positive sentiment and accumulation advice. You, the reader, or in this case you, the listener, kind of have to connect those dots.
And that performance data for the week itself, showing a slight dip across most indices. It just reminds us that even within a positive trend, there are down weeks. But the underlying valuation differences, large versus small mid, remained quite stark.
Absolutely. So what this deep dive gives us is this multi-layered view. Early June 2025 Indian market, trading at relatively full valuations, particularly outside large caps. This leads one specific model to project moderate 6.3% future annual returns.
Right.
But it's also a market that had seen recent positive momentum, improving FII interest, and positive sentiment noted by the source following some earlier choppiness.
And based on that, the source suggested strategies like accumulating, regular investing, and focusing on specific sectors.
It really captures that classic market dynamic, weighing current positive signals against underlying valuation levels that might influence longer-term outcomes.
It's about trying to balance all those different signals.
For sure.
So, reflecting on this whole picture, the relatively high valuations, That specific 6.3% return projection from the source's model, the recent positive trend signals, and those investment suggestions, it leads us with a final thought to ponder.
Yeah, given this mix, the momentum, the sentiment, the sectors highlighted, but also the valuation context and that moderate return forecast, how do you, the listener, process this? How might you integrate these different pieces of information?
Which signals carry more weight for you? How do you balance the potential for growth that the source seems to hint at with its recommendations against the valuation picture and that specific 6.3% number?
It really comes down to how you weigh short-term signals versus longer-term valuation perspectives when looking at the market at that specific point in time. Something
Yeah.
to think about.